What happens to depositors' assets when a crypto exchange files for bankruptcy? In a single sentence, the companies that hold your crypto are not insured the way banks are. And if the crypto company goes bankrupt, then customers may be treated as unsecured creditors, meaning they may not get anything back. Cryptocurrency does not have the same level of protection as your other deposits. Cryptos are not federally protected or regulated in the same way the funds in your deposit accounts may be guarded in the event of your bank or credit union fails. While the FDIC and NCUA insurance protects fund in a traditional savings account, certificate of deposit, money market account, etc. up to $250,000 per deposit per bank for each account ownership category, the government does not step in to help investors recoup any funds they have put into a cryptocurrency exchange. Now, in the case of a regular brokerage accounts, if you have an IRA or a taxable account of stocks and bonds with a registered broker dealer that is a member of SIPC or Securities Investor Protection Corporation, you will receive up to $500,000 of protection should that brokerage go bankrupt. On top of the SIPC insurance, a brokerage may provide additional protection to its customers through private insurers like Lloyd's or Swiss Re. In addition, the Securities and Exchange Commission issued a customer protection rule that requires registered broker-dealers to safeguard customer securities and cash, prohibiting the dealers from using any customer money to fund the firm's overhead or other expenses. Now, in the case of 401k, if your employer goes belly up, legally, the money in your 401k cannot be treated as a company's asset by a bankruptcy court. Now, crypto custodial accounts, however, do not enjoy those same safeguards, in part because the legal, tax, and regulatory frameworks are still worked out. Cryptocurrencies are not always viewed as securities by many governments in the world. So, what happens to your funds in the event of bankruptcy is ultimately up to your individual exchange. And different exchanges have different rules about what would happen to their customers' funds in the event of a bankruptcy, with some exchanges listing in their terms that the funds may not be recoverable. What's more, customers may unwittingly agree to let the company running an exchange or platforms use their digital assets. There are some platforms that have agreements which essentially say, by depositing your crypto with us, you are granting us the authority to use, transfer, invest, or do whatever we want with your crypto. So, best advice is to read the legal fine prints before buying, selling, or storing digital assets with any company facilitating crypto trading to see what protections they do offer. Now, let's talk about the situation of FTX. A Chapter 11 case holds attempts to recoup assets from a bankrupt company, so customers will have to wait for the bankruptcy courts to determine how much, if anything, they will get back. One of the key questions of the court will be whether customers own the cryptocurrency they deposited or whether it is FTX's property. There is very little legal precedent for that question. In recent crypto bankruptcies, Celsius Network and Voyager Digital both claimed they owned all crypto held on their platforms. That means the crypto would be pooled with all of the bankruptcy company's assets and divided to pay all the creditors. In that scenario, customers would have what are known as unsecured claims that would be relatively low in priority. Bankruptcy judges have so far accepted Celsius and Voyager's arguments, although they could be subject to further court battles, of course. If customers are found to own the crypto, they stand a greater chance of recovering a large portion of their deposits, but the recovery will still depend on how much FTX owns and what assets it has left. Now, the question is, what about FTX customers who withdrew money from FTX? Now, customers who withdrew their assets from FTX before its collapse are not necessarily in the clear. The bankruptcy court might authorize FTX to claw back those withdrawals so that there can be more equal payment for creditors who were unable to make withdrawals. In cases involving fraud, the clawback period can extend for years, and which is a possible case in the case of FTX. So overall, how can I protect my crypto? Start by re-evaluating how and where you are storing your crypto. When you purchase cryptocurrency on a crypto exchange, your funds are immediately stored in your exchange hosted wallet, which is a custodial wallet, meaning that specific exchange controls your private key, which is a password that gives you the power to access and manage your crypto. A non-custodial wallet, on the other hand, gives users full control over their private key through storage via a browser-based software or on your computer's hard drive. The catch here is web-based wallets through a crypto exchange makes it easy to access your funds and password if you forget it. However, when you opt for a non-custodial hardware wallet, forgetting your private key could mean losing your funds forever. Even if you purchase your crypto on an exchange, it doesn't have to stay there. In the event of a bankruptcy, keeping all your crypto in a web-based wallet could mean having all your funds frozen or losing them altogether. That pretty much wraps up this video. If you liked it, do smash the like button, and also don't forget to subscribe. See you in the next one.